Hey out there, welcome into another exciting, I hope it's going to be the best edition yet of Market Takes. I am Dion, Rabouin, reporter at the Wall Street Journal. I want to thank all of you all out there for tuning in to our very special jobs report edition of Market Takes. We are just going to be unpacking the jobs report this morning, talking about what we saw, what we found, and why it matters. And I'm going to be giving you some inside information about, what's really moving in that report and what are some of the little details that I think are important to pay attention to and to lock in for. We're also going to talk about what the market's seeing and taking away from this and how this could move stocks, bonds, commodities, Bitcoin, crypto, etc. going forward. So we're going to jump into all of that, but wanted to thank you again for being with us here on this live stream. We usually do it on Mondays, but every now and then we get a big market moving economic piece of data that inspires us to come on here and let me talk a little bit straight to you. So we're doing that this morning with the June non-farm payrolls report, and we're going to dive into that. So what did the jobs report this morning tell us? Well, it told us that hiring is still strong. We got 372,000 jobs added in June. The pace is still strong, way above expectations, though slowing a little bit from the May pace. But the big picture, we've known that this economy was adding jobs. We've known that the labor market was strong and tight. But what did we really learn about inflation? And what did we learn about the possibility of recession? So we are going to dive into all of that. So look, how did what we learned in this job report compare to what we knew before? What does this jobs report tell us about the overall pace of inflation, and particularly wage inflation on the labor market side? That's something Fed Chair Jerome Powell has really pointed to as being a potential problem area for the economy, as one of those wage price spirals that we could see. And the big question is, how are companies going to respond? If wages keep ticking higher, that's a bigger piece out of company profits. That means stock prices could go down. That could be another thing that contributes to the recession. And, the other thing is a strong report on the jobs front could be negative for markets. And I'm going to talk about why that could be and what we're seeing. But the big question is the R word, recession. What does this jobs report that we got today tell us about the potential for a second quarter recession? As we said in the title and the headline of this report, this is probably one of the biggest, if not the biggest, pieces of data that we've gotten about the second quarter so far. If you remember, the first quarter, we had negative GDP. Now, traditionally, when there's two quarters back to back of negative GDP, that means a recession. Well, we've already got one in the books, and the Atlanta Fed, if you watch their GDP Now report, is predicting negative 2% growth in the second quarter. That would be back-to-back quarters of negative economic growth, which would likely mean that we are in a recession right in the second quarter, that's already happened. But what does this jobs report tell us about that likelihood? And what were some of the potential negatives, even though we did see that strong number overall on the headline? So we'll get into all of that, everything about inflation, recession, and the labor market. But first, let's check in and take a look, WSJ.com, at how the market reacted. Now, those futures prices were lower immediately after the report came out. We did see the market pick back up, especially the Dow and the S&P a little bit, even going positive for a brief second right as the market opened. We've seen that reverse, and now stock markets, basically the stock market across the board is negative. The Dow is down about 0.4%, S&P 500 down about 0.65%, the NASDAQ is off about 0.9%, down almost 1%. Still not at those lows that we saw before the market actually opened, but the stock market's saying, we're not exactly excited about this. Look, I think more important than the stock market is what we're seeing right now in the bond market. We have seen a yield curve inversion for the second time this year. That's where the 2-year yield is higher than the 10-year yield. Essentially, if you own a 2-year bond, if you borrow money, or if the government borrows money from you and is going to pay it back in 2 years, they're paying you more than they would if they're going to pay it back in 10 years. If you just think about that, that doesn't make sense, because people are more likely to pay you back in 2 years. You also want to get your money back in 2 years more than you want to get it back in 10 years. You'd want to take less money for that, you'd think, but right now investors are saying, down the road is not looking so great. We want to get that money now rather than in the future. And that's why you've got 2-year yields above 10-year yields. That is a long-term recession indicator. We saw the yield curve invert a couple of months ago. It is now inverted again. I've got a whole video out about some of these recession indicators that can be coming out a little later today. So if you're on my channel page on YouTube, make sure you check that out. We've talked about 4 big recession indicators that markets tell us, and that's gonna be coming out on my YouTube page a little bit later today. The other big thing that's been kind of portending a recession has been some of these commodity prices. We have seen big declines in the price of oil. Oil up right now on the back of this about 0.6%, but we are down well below that $120 a barrel level where we were just a couple weeks ago, now at about $103 a barrel. That is a significant step down. Natural gas well below where it was. So those things are good for your bills. Hopefully that means the price of gas is going to come down. Hopefully it means some of those utility bills are going to come down. But those prices are coming down because investors are predicting a weaker and softer economy going forward. That's the big picture there. We've seen that with oil. We've seen it with copper prices. Those are down as well. So make sure you're keeping an eye on those commodity markets because they tell us a lot about what investors are thinking. So look, jumping back into the jobs report and the information that we got today. 372,000 jobs added in June. That is a well above expectations number. Economists had been predicting about 260,000. We got 276,000, excuse me, according to FactSet, and we got 372,000. So almost 100,000 more jobs added than expected. Now that is down from the pace that we saw in May of 390,000, but again, we are still well above expectations and still well above the pace needed to add jobs to just keep up with the population. What could be some of the biggest takeaways from this report? We are going to get into all that, but the number one takeaway that I have when you look through the numbers and you see this strong report, the negative takeaway is that it means the Fed probably needs to do more. It likely means a 75 basis point rate hike is locked in for this month at their meeting. That's 3 times the rate that they normally raise rates at. They did it in June. It's likely they're going to do it again in July. Atlanta Fed President Raphael Bostic was in a meeting this morning discussing what they'll likely do. He says, you know what, the case is there for us to raise rates at 75 basis points this month. He thinks they're locked in for this pace. He's not a voter, so he doesn't actually get to vote this year, but generally speaking, he's in line with the consensus of the Federal Reserve and of Fed Chair Jerome Powell, the most important member of the Federal Reserve. So we can expect that to be locked in, and markets are telling us that they expect 75 basis points rate hike this month at the Fed's meeting. What that means for you, if you've got a credit card, those credit card rates are going up. If you've got a personal loan, those rates are going up. Home equity line of credit, things like that. All those variable rates that you have, variable interest rates, those are all going to go up, and they're going to go up by quite a bit. So be sure you're checking your statement. If you're only making those minimum monthly payments, you might want to think about paying a little bit more. Listen, what we learned about inflation, that's been the big key, right? Because we've known the job market is strong, but what did we learn about inflation from this jobs report? Well, average hourly earnings up by 5.1%. They revised May higher to 5.3%, but it looks like we're starting to flatten out on that average hourly earnings number. Now, that's a good thing and it's a bad thing. It's a good thing because it means that those wage increases are starting to moderate. Fed Chair Jerome Powell was very worried that we might have a wage price spiral, which is where wages just keep rising and rising and rising, get out of control, and that just keeps inflation elevated. It doesn't look like that's the case here. 5.1% after 5.3%. And if you remember in April, we were at 5.5%. We were at 5.6% in March. So wage gains are slowing down. The pace of increases is slowing down, and that's a good thing for overall inflation. For the lowest wage workers, average hourly earnings remained high. That means the lowest wage workers, the people who are being paid the least, are seeing the biggest wage gains. The Atlanta Fed tracks this. It's going about 6.5% compared to that 5.1% rate for workers overall. So low wage workers are seeing the biggest increases from this. Those folks who have been at the lowest end of the economic totem pole getting the biggest boost, that's a good thing. Why this is a bad thing? Well, wages aren't keeping up with inflation. If you remember, last month we got the CPI report on inflation for May. That showed that inflation was rising at 8.6%. So inflation was 8.6% in May, and in June we saw the pace of wage growth is sliding and coming down. Now it's at 5.1%, moving further away from the pace of overall inflation. That means that workers' wage increases, their pay gains, are not keeping up with inflation. That is a bad thing. This could also be the first preview of what inflation and that CPI report will show us for July. If you remember, we got the JOLTS report, job openings and labor turnover survey. That just means how many job openings are there, how many employers got those, or how many employees are now on the rolls, how many workers got those jobs that were available. JOLTS report showed job openings fell in May, but still over 11 million. Openings, the number of people looking for workers, outnumbered the number of unemployed workers almost 2 to 1, 11.25 million job openings to 5.5 million unemployed workers. And the caveat to this very strong report that we got today is labor force participation declined. That's probably what kept the unemployment rate about where it was at 3.6%. And we are still well below the number before the pandemic. Labor force participation at 62.2% was 63.4% in February of 2020. There are still 524,000 less people employed right now in June, at least in June of 2022 than there were in February of 2020. We've had a population growth since then. We've had a lot more folks turning 16, turning 18, entering the labor force, and there are 500,000 fewer people employed now than there were 2.5 years ago before the pandemic. That's something to keep in mind when you're seeing these numbers. Don't forget that. So let's look at the likelihood for recession. If we are in a recession, this is an unusual recession, and that's something to keep in mind. Hiring kept pace with the growth of population. Yes, absolutely. But those wages are not keeping pace with overall inflation, and we are not seeing any signs that inflation is going away anytime soon. Looks like it's moderating. Like we said, that oil price has been going down. If you've noticed, the price of the pump has been going down. That's been a big, massive contributor to the pace of inflation. But again, it's not looking like we are seeing wages keep up with overall price gains, and that could be the thing that really tips the country into recession. Now, just looking at it from a jobs perspective, a leading economic indicator is the average weekly hours worked by manufacturing workers. That stayed at 40.5 hours. That's little change from May. That's one of the LEI, one of the secret indicators that economists really look to as a leading indicator of recession. That stayed right where it was, didn't move very much from May, suggesting that employment growth is not slowing down. We're not starting to see significant layoffs. Hours matter, and the reason that why economists watch the average hours worked is because it really, before employers start laying people off, they start cutting hours. When you start to see hours getting cut, that's a sign that we may be going into a time where we're seeing more layoffs, more job cuts. Now, that Challenger job cut report from Challenger, Gray, and Christmas, it's a little watched report, but one that I've been watching lately because you're hearing all these talks about layoffs in tech, you're hearing all these talks about layoffs in the financial industry, et cetera, et cetera. Well, if you look at the straight numbers, layoffs did increase in June, but only up to about 32.5 thousand last month. That's 50% above where they were in May, but that's still well below, and I mean 12,000 below the trend of layoffs from 2015 to 2020, right before the pandemic. So really till the end of June, or till the end of 2019. That 5-year period, the economy was good, the economy was strong, the stock market went up, we were not anywhere near a recession, and job cuts averaged 44,000. We're just now getting back up to 32,500 in June, still well below the pace that we saw from those 5 years, even before the pandemic, so not counting those huge losses. Again, so job cuts are starting to pick up. We did see 32,000 up from about 20,000 the month before, but that's still well below the pace that we saw even when the economy was good, chugging along, doing well, essentially for the country overall. Look, The big picture is if we are in a recession, and the odds have grown immensely as you look at that Atlanta Fed GDP now, if you look at retail sales, if you look at some of these other reports, that we are in a recession right now in the second quarter, and as we move into this third quarter in the US, odds of a recession have increased pretty significantly. But if we are in a recession, it is a very strange and unusual recession, one that may include continued job growth, that may include an unemployment rate at around 3.5%, and may include some of the things that we really haven't seen before in the US economy. So, look, takeaways as we wrap it up here on Market Takes. The jobs report showed strong hiring again. A lot of people were worried that, oh, we could turn around, we could see the labor market turn over. Didn't happen. Wages strong, job growth strong, continued hiring. But that's worrisome because it means the Fed still has a lot of work to do, and we could see a lot more rate hikes in front of us. No wage price spiral. Try saying that 3 times fast. But again, wages not keeping up with inflation. And this could happen. We've gone through a period where things are not the way they were before, where the labor market doesn't work the way it is before, and that's going to continue. So if we do see a recession, if we are in recession, even with a 3.6% unemployment rate, don't be that surprised. That's all I'm saying. Look, thank you all for tuning in to Market Takes. I am Dion Rabouin, reporter with the Wall Street Journal. We are going to be doing this again next week, so please check in and stay with us. We're going to keep doing this live stream, and we hope to see you there with us. I'm going to be signing off right now, but thanks everybody for tuning in. I hope to see you